All right, so breaking news this morning, the Bank of Canada has just cut interest rates by another massive 50 basis points, dropping the current rate to 3.25%, down from 3.75% at the last rate meeting that took place in October. And this is also down a total 1.75% from the 5% rates that were in place in early 2024. Now, the Bank of Canada stated that their reasoning behind this second consecutive 50 basis point cut was a combination of inflation hovering around 2%, an economy experiencing excess supply, and recent data suggesting slower than expected economic growth. So the governing council chose to cut the policy rate by an additional 50 basis points to stimulate growth and maintain inflation near the midpoint of the 1 to 3% target range. Now, despite the Bank of Canada's reasoning behind this decision, though, to me, this indicates to the Canadian people and the world really that Canada's economy is hurting and that the Canadian people isn't thriving or being nearly as productive as it needs to be in order to continue competing on the world stage, specifically though with its largest trading partner being the United States, of course. And cutting rates by this much once again will for sure, alleviate monthly running costs for millions of Canadians, but it's mortgaging the Canadian dollar's value both in the short term but also more importantly in the long term. And objectively speaking here, regardless of what political party you back or whatnot, it is just fact that Canada is becoming a really strange and, dare I say, even somewhat sad place to be when you really take a bird's eye view of what's going on in the country from an economic and cultural standpoint, rather than anchoring your perception of Canada as a country as what it was 10, 15 years ago, being the country we all knew and loved, which is kind of what I think a lot of people are trying to do in order to justify the country's current realities. With that said, we'll be talking about GDP growth, potential tariffs on Canadian exports into the US, new immigration policy moving forward, as well as, of course, the CAD USD conversion rate. Let's do it. First things first, can we take a moment to appreciate this chart? It is just remarkable how bad the FX conversion between Canada and the US dollars are right now. And if we zoom out on the chart, we can see that we're approaching conversion rates seen in 2020 at the height of the pandemic, the beginning of it. But the problem here is that the current situation is a lot worse than in 2020, because in 2020, this was more of a shorter term and direct reflection of the fact that Canada basically shut down the entire country and economy nationwide. I mean, here in Quebec, we had an 8 p.m. curfew and we could only buy select items at the store, even though we were physically already there. It was absolutely insane, but that was during a time when many states in the US were completely open for business. So of course, the economy was rolling quite a bit more than here in Canada. The point being though, that rate conversion reeled right back in within 12 months or so, but since then it has gradually been creeping higher and higher and higher in the face of a country, Canada that is, that's just not putting up the GDP numbers that it needs to be relative to the US to maintain a strong conversion rate. And I fear that this will only get worse from here on out, especially when the upcoming political changes in the US and their talk of imposing tariffs on Canadian exports, along with the long-term financial damage that's already been done in Canada that's crippling Canadians' finances in the short term, but that will continue to linger for years to come, unfortunately. Now, yes, the Canadian dollar did jump on the rate cut announcement this morning, but like to the people who commented on my video back in August, that video being about the Canadian dollar crumbling, I will remind you that in the markets, short-term movements on news are only relevant to traders who make income on these movements, right? But that it's long-term performance of the company or market in question that dictates where its value will be 6+ months down the line, which is exactly why we're seeing the Canadian dollar down another roughly 1.75% from the peak in August. And just like how a business's value grows through economic output and productivity, a country is kind of the same, and Canada is just not putting out the growth figures required to maintain its value. In the shadows of the US, that's absolutely on fire right now, and that's despite these potential tariffs that might come into play, hurting our economy even more. So yeah, if you haven't heard, the United States has announced plans to potentially impose a a 25% tariff on all products imported from Canada and Mexico, which would take effect on January 20th of 2025. And these proposed tariffs are part of broader measures targeting trade with multiple countries, including China, of course, and are framed as addressing national security concerns such as drug trafficking and immigration issues mainly. The thing is, these new tariffs would significantly disrupt industries that rely on cross-border trade under the United States-Mexico-Canada agreement, especially sectors like automotive manufacturing, agriculture, energy, and consumer goods. Realistically though, we'll see if this ends up materializing because of course this move is expected to provoke retaliatory tariffs from Canada, which would impact US exports to the country as well. And that's on top of the fact that the US imports a ton of energy from Canada, so higher energy costs wouldn't benefit the US either. Overall though, it's just a strange situation all around, considering Canada and the US have had decades of successful partnerships. Overall though, if these tariffs were to come into effect, they would hurt the Canadian economy a heck of a lot more than they would hurt the American economy. And I wouldn't be surprised if we see the Canadian dollar drop in the mid 60-cent range if that does end up happening. So with that said, let's talk GDP growth because that's the biggest issue contributing to all of this. Canada's economy has now lagged behind its population growth for 5 consecutive quarters, with real GDP per capita dropping 0.1% in Q2 of 2024, according to recent data from Statistics Canada. And this marks a 2.2% decline from the same period in 2023 and a 3.6% decline since 2022. Really what's tough to see unfold though is the contrast with the United States, where in the same period, the US saw a 0.6% rise in real GDP per capita in Q2, reflecting a 2.6% annual increase and a 4.5% growth since 2022. And if Canada had matched US growth over these past 2 years, its economy would be 8.5% larger than it is today, equating to roughly $6,200 more in annual income per Canadian. However, the situation gets even worse and the challenges extend beyond this data point alone. To illustrate the growing disparity, consider the latest data from the OECD for 2023, adjusted to reflect projections for 2024 based on performance in the first 2 quarters and the IMF's recent outlook. So in inflation adjusted 2015 dollars, the US now boasts a real GDP per capita of about $66,300, which is significantly higher than Canada's $44,400. So there is a huge gap forming here. And these figures represent purchasing power parity adjusted real GDP per capita, which also accounts for differences in price levels between Canada and the US. And this adjustment is crucial because a dollar in Canada buys fewer goods and services than a dollar in the United States. And it's also normalized for inflation over time. In essence though, these numbers highlight disparities in average living standards between the two countries, where this $22,100 gap in 2023, which is equivalent to about $28,000 in 2024, taking into account inflation and then the FX conversion, is very substantial. And to put this in perspective, real GDP per capita in the US was 43% higher than in Canada in 2023, and this gap is projected to grow to nearly 50% in 2024, which means the US is set to produce almost 50% more per person than in Canada. And just anecdotally, being a Canadian who travels a lot to the US, I can absolutely believe that, as work culture is simply not the same in the two countries. Anyways, I was going to talk about immigration changes and housing issues relating to this rate cut and other news, but I kind of already covered all of this in detail in the last video I made on the channel, so check that out if you're interested. The bottom line though is that this rate cut will of course help more buyers get into the market, with the most traction from it expected to be in the spring, as that's really when the Canadian housing market always takes off a little bit more. But all of this also means increase competition in the buyer's market and therefore increase prices, as Canada is just terrible at putting in place zoning and permitting systems that allow for more streamlined building and more housing in general. But hey, I'm a broken record on that issue at this point. It's just true though. Hey, if you're interested in learning more about investing in the stock market, make sure to check out my entirely free to watch 7.5-hour course over on Skillshare. It has, I think, around 3,000 students at this point and enough content to get you very familiar with navigating the stock market on your own. Additionally, if you need to open up a TFSA, RRSP, or other investment account, do so on Moomoo. They have the best sign up bonuses if you use my link down below in this video's description and pinned comment. Thanks a lot for watching. Subscribe.